What's going on, team? It's Caddy with Money Investing. I hope that you all are having an amazing day. So in this video, I will give you guys an update on the S&P 500 futures and the S&P 500 index itself, how the markets have been performing on the day, where do we stand on the day, on the week, and year to date. Are the markets up or down, and where do I personally see the patterns and the stock market going next week? If you guys enjoy this video, please make sure to give it a thumbs up because it really helps out with the YouTube algorithm and recommends this video to other people who might be interested in watching as well. Also, subscribe and hit that notification bell so you don't miss out on any future videos related to market updates, stock breakdowns, and technical analysis. I really do appreciate you guys' support. So now let's jump over to my TradingView platform. Again, this is the platform that I like to use to look at all my charts, all my patterns, create different watch lists, and create alerts. So if you want to get started, all the links are going to be down in the description below. So the first thing we're going to look into is going to be the TVOL index, or the total volume index. And I did update everybody yesterday and this morning, essentially mentioning the Quadruple Witching event that's going to take place today in the markets. That's an event that happens 4 times a year and essentially on the third Friday for the months of March, June, September, and December. And what happens is most of the futures and options contracts are expiring. So most of the institutional investors and traders need to make a decision whether they're going to hold on to their hedges, whether they're going to roll over these contracts or close out of their positions or open new positions. So looking at the TVOL index, and if you go over to the daily chart, you guys can see that this spike right here all the way up to 3.5 billion shares that were traded in the New York Stock Exchange was an increase of close to about 248% from previous days. So we had already identified some of those previous historical Quadruple Witching events going back as far as June of 2019. You guys can see that back on June 21st, which was also the third Friday for the month of June last year, we saw a spike and there were about over 2 billion shares that were traded on that day. This right here is going to be September 2019's Quadruple Witching effect. This right here is December of 2019, and then if you move forward, this is 2020, and this right here is March 20th, again third Friday for the month of March this year, and this is June 19th, third Friday for the month of June, and we've seen such a spike in the volume for the New York Stock Exchange. Now, if you were to track this volume back and when was the last time you traded at 3.5 billion shares, you'll notice that this trend line horizontally goes back as far as March of 2017. So if you were to put a trend line right there, you will notice that we haven't reached this volume since 3 years ago, since March of 2017. So that just goes to show how much volume there was in the markets today. And the S&P 500, even though it was down close to about 60 basis points on the day, the ETF SPY, which trades after hours, was down close to about 1 to 1.5% on the day after hours, which is going to be ticker symbol SPY. Again, that's the S&P 500 ETF that tracks the market benchmark. So you can see how it was down 1% on the day. After hours, it was down another 60 to 75 basis points, close to about 1.75% on the day. Dow Jones ended up down 80 basis points, and Nasdaq was essentially flat, up just over 3 basis points, and it's being held up. And it has been trading sideways, or it has been ending green, due to the fact that Nasdaq tracks all the big tech companies like Amazon, Apple, Facebook, and Microsoft, and those have been doing incredibly well as opposed to some of the other companies in different industries. Speaking of Apple, Apple also reported that they were going to close their 11 stores in Florida, Carolinas, and Arizona due to the resurgence in cases that we have seen. And since Apple has a really heavy weighting in the S&P 500, that is what essentially drove the S&P 500 to go into the red, because Apple dropped close to about 0.5%. Another negative catalyst that came out in the markets today was from World Health Organization, WHO, and they essentially said that the cases and the virus itself is entering a new and a dangerous phase. I'm not sure what that phase looks like, but that's essentially what they said. As soon as they delivered that message, the S&P 500 and the Dow Jones both essentially sold off aggressively, ending red on the day. On the week, however, we're still up. S&P up just over 1.8%, Dow Jones up just over 1%, and the Nasdaq is well over 3.7% on the week. On the year, however, we're still in the red. S&P down close to about 4%, Dow Jones close to about 10% in the red, and Nasdaq is the only index out of the three which is up on the year, over 10% gain since the start of this year. So now let's jump over to the tick index, which is a New York Stock Exchange cumulative tick index that essentially takes takes into account how many stocks are moving up versus how many stocks are going down. So it will give you a positive or a negative value. If more stocks are moving higher, it will be a positive value. If more stocks are moving down, if they're declining in value, it will be a negative value. So we looked at quadruple witching, and we also understood that there was a spike in volume. We also understood that there were two negative catalysts that essentially drove the markets lower, and we saw a huge sell-off in the markets, both S&P 500, Dow Jones, and the Nasdaq, and only Nasdaq was the one that essentially closed flat, up 3 basis points on the day. Something that I want you guys to keep a close note of is going to be this right here. This is the tick index, and if it's trading below the white line that you guys see, that means there are more stocks trading down and declining in value as there are trading higher and increasing in value. So you can see the market gapped up. This right here is going to be the market open. As you guys can see at 9:30 a.m. it was gapping up, but then it was selling off. If you guys can recognize that pattern, is making lower highs and lower lows, and it was essentially selling off during the day, and eventually it made its way back below the white line, essentially showing a sign of weakness, after which it started consolidating and it was trading higher and lower, both above and below the white line. If we were to pull back on this tick index, you can see that we have been consolidating for the longest time, because there's been candles that are trading above the white line and also candles that are trading below the white line. That means that the pattern in general, the S&P 500, Dow Jones, and the markets overall have been trading sideways, and which is what we've seen in all of my market updates. If you've been following up with all these stock market updates that I put out every single day, we track down and identify the S&P 500 futures and where those key support and resistance levels are. So now let's just jump over to those patterns, and we will identify some of those key support and resistance levels for the S&P 500 futures. Alright guys, so this right here is going to be the pattern for the S&P 500 futures, and we've been tracking it for now well over a week, going back as far as Thursday, June 11th. Now before we dive into this pattern, if you guys really enjoyed this video, please make sure to drop a like. It really helps out with the YouTube algorithm and recommends this video to other people who might be interested in watching, and as a result helps the channel grow. So I really do appreciate you guys' support. So last Thursday we saw a huge sell-off. Both the S&P 500 and Dow Jones dropped close to about 6% in value. But going into Friday, we saw a gap up and the markets were essentially trading higher pre-market, but they sold off, making lower highs and lower lows, which you guys can see right here, that it was selling off and making lower highs and lower lows. And it briefly breached the 3,000 level. It sold off down to this level, but then quickly reversed and pushed up higher. Over the weekend, the futures opened lower, consolidated right around the 3,000 level before breaking down. And then on Monday, it rallied back all the way up to 3130, essentially on Fed news when they came out and said they were going to start buying ETFs and individual corporate bonds. So essentially any company who wants to raise money through debt, the Federal Reserve will buy the bond. Now, since Monday of this week, we have seen such a massive consolidation, and the fact that we have been trading sideways for the longest time. And this right here was the red area, or the red range, that we have identified in all of my previous market updates, and kind of like those 4 key levels that have been validated not once but multiple times. The 3150 level, for example, is a very clear resistance for the S&P 500 due to the fact that it has gotten rejected at that level on Tuesday, on June 16th, and then again going into Wednesday right around here. The 3130 is going to be the next resistance for the S&P 500, again due to the fact that it has gone rejected here on Wednesday and then also multiple times on Tuesday. The support we recognized at 3080 because of the fact that it has been validated multiple times and the pattern usually changes direction and has bounced off of those levels in the past. And then 3060 is going to be again a very key level which the pattern has found a support at, because it bounced off of that level on Tuesday, and then on Wednesday night it bounced off of that level right here. So now before we talk about today's trading activity, if you guys watched my market update from this morning, I essentially said that I don't care much about the fact that the market is gapping up or down. I care more about the intraday pattern and where does it trade on a day-to-day basis. So are we seeing some type of weakness? Is the pattern making lower highs and lower lows? That to me is more important than the fact that the market gapped up and it's trading 1% higher pre-market, because of the simple reason that we see a lot of volume during trading hours as opposed to pre-market. So there's a lot more investors, traders actually watching and trading the market while the market is open as opposed to pre-market. So from a liquidity and volume standpoint, the direction during market hours is a lot more important than where the market is coming from, if that makes sense. So the market did gap up, and I recognized this similar to last Friday when the market gapped up, but then it started making lower highs and lower lows. That's exactly what the pattern did today, and we did an incredible job recognizing that, right? So we did an amazing job understanding that there's a clear resistance at 3150, and that's exactly where the pattern got rejected as soon as the market opened, and then it sold off, started making lower highs and lower lows before breaking below of its 3080 support. It did that briefly right here, but then quickly changed directions and pushed up, got rejected at 3100 twice. So this right here is a double top, and then essentially broke down after hours due to the increased volatility because of quadruple witching. So now it's trading well below its 3060 level, and this is the first time since we've been tracking it for now well over a week, the first time that the pattern has essentially broke below this red area that we have recognized as a very clear range of consolidation. So now let's just jump over to the 1 hour chart to identify where the market can potentially go going into next week, and where do I see some of those levels that are going to be really important for us to watch. From a 1 hour standpoint, this right here was the range that we were following very closely on the 5-minute chart, right? So this has been the consolidation area. And as you guys can see, the candle today closed well below that range. And now we can see a further breakdown on the pattern if there's increased volatility in the market. Because of the fact that we're seeing so much weakness in the pattern, and it has created a double top or almost a triple top at around 3150. So there's very clear validated resistance at 3150, which I want you guys to look out for very closely if the pattern were to reach that level again. But looking at it from a technical standpoint, the next support for the S&P 500 futures is going to be right around the 2990 level, which essentially represents a drop of close to about 2 to 2.5%. Again, this is just my opinion and my analysis based on technical factors, and due to the fact that the market did break below its very key support at 3060. Now, if it were to break its 3000 level, then I'd see the pattern going even further down to the 2920 level, which is going to be another drop of close to about 2 to 2.5%. So overall, from where the market is right now, the next support at 3000, more so at 2990, and then the next support at around 2920, that can potentially lead up to a 4 to 4.5% decline in the S&P 500 futures. Again, please make sure to do your own analysis and your own research when you're investing in the stock market. I hope you guys enjoyed this video and my quick technical breakdown of the S&P 500 index and where do I personally see the stock market going in the near future, going into next week. We did break down of some of those key levels that we have recognized in prior days and prior market updates. Moving forward, there is a form of weakness in the patterns, and there is a very clear resistance at 3150, which S&P 500 has struggled to break out of the entire week. If you guys enjoyed this video, please make sure to give it a thumbs up and subscribe to the channel and hit that notification bell for all future videos. As always, happy investing, and I will see you guys in the next video.